China's auto giants aren't easing up. They're scaling globally with laser focus. BYD plans to sell half of its vehicles outside China by 2030, and it's already laying the groundwork with factories in Brazil, Southeast Asia, and soon, Europe. Geely and Chery are pushing into high-demand markets with sharp pricing and fast rollouts. Meanwhile, Western automakers are scrambling to catch up. General Motors is reshuffling its supply chain, Ford is leaning on commercial sales to stay afloat, and Volkswagen is racing to launch cheaper EVs like the ID Everyone. But it may be too late to lead. The best they can hope for now is not to fall further behind. Tesla's situation is the most precarious. With Q2 deliveries down and Musk's leadership under scrutiny, investor confidence is slipping fast. Its stock has dropped 20%, and with tariffs looming, battery material risks rising, and federal tax credits under threat, the company's once dominant position is cracking. The next phase of the EV war won't just be about range or price, it will be about resilience, speed, and global adaptability. And right now, China's automakers are the only ones hitting all three. In the end, let's take an overview of the details from today's video. China's automakers are faster to develop, cheaper to produce, and expanding globally at full speed. US companies are burdened by trade shocks and internal slowdowns. Germany is reacting too late. BYD leads a wave of challengers reshaping the global auto map. Tesla, once the EV leader, now faces challenges it needs to overcome fast. So will US and German legacy automakers find the speed and vision to turn things around? Or has China already secured the lead in the next era of driving? Comment below. Hit the like and subscribe for more updates. See you in the next video. Even more troubling, both companies are hemorrhaging profitability in their EV divisions, which continue to post steep losses despite increased sales. Then there's Tesla. Its first quarter profits declined 71%, and it delivered 384,000 vehicles in the second quarter, the biggest quarterly drop in its history. Elon Musk's political tangles and split focus have only added to investor anxiety, with Tesla's stock down 20% this year. While Chinese brands are surging ahead with speed and agility, America's auto giants are bogged down by tariffs, distractions, and outdated strategies. And Europe's automakers, they're not doing much better. Germany's auto titans, Volkswagen, BMW, and Mercedes-Benz, are being squeezed from all sides. In April and May 2025, German vehicle exports to the US dropped by 13% and 25% respectively. That's just 64,300 cars shipped in 2 months, a crushing blow in their most important foreign market. The cause? A 25% US tariff on EU car imports plus a 50% steel tariff is shredding profit margins. Volkswagen is feeling the pain. Its US sales plunged 29% year over year in Q2, with only one model, the Golf R, showing any growth, and that's a niche hot hatch. Every other model is in decline. CEO Oliver Bloom admitted that the company rested on its laurels too long and was caught flat-footed by China's rapid rise. Volkswagen is now scrambling to respond, planning to cut 35,000 jobs by 2030 and belatedly rolling out low-cost EVs. Meanwhile, Chinese EV sales in Europe have more than tripled since 2019. The EU's 10% tariffs haven't slowed them down much, and fears are growing that vehicles meant for the US will be dumped in Europe instead. With US tariffs biting and Chinese EVs flooding Europe, German automakers are losing both their grip and their pride. No company better represents China's EV dominance than BYD. In the first half of 2025 alone, it sold 2.1 million vehicles, outpacing Tesla to become the world's top EV maker. In June, BYD moved a record-breaking 377,628 units, and that momentum doesn't seem to be slowing, even with global headwinds. What sets BYD apart? Speed, scale, and control. Unlike Western automakers that rely heavily on suppliers, BYD manufactures most of its components in-house. It employs nearly 900,000 workers, nearly the same as Toyota and Volkswagen combined, and operates with relentless efficiency. While legacy automakers take 4 to 5 years to develop a new model, BYD does it in 18 months and updates frequently post-launch based on real-time customer feedback. Its international expansion is equally aggressive. In Brazil, BYD sales surged 327% in 1 year. The company recently opened a $1 billion factory there to dodge incoming tariffs and localize production. In Southeast Asia, it's dominating Thailand's EV market. But why are BYD and China more broadly succeeding while the West is spinning its wheels? Let's break it down. 3 core advantages explain China's EV rise. Speed. Chinese brands launch vehicles in 18 months. Western firms, 5 years. That speed saves money, gets tech to market faster, and allows for rapid iteration. Think software updates with wheels. Scale and cost. China's massive overcapacity isn't pretty, but it works. The country can build 54 million cars a year, nearly double its actual demand. That forces down prices. BYD's Seagull EV sells for 7,789 yuan in China. Try matching that in Detroit. Strategy shift. Chinese firms treat model launches as ongoing development, not final products. They rely more on simulations than endless crash tests. Is it risky? Yes, but it's also efficient and it's working. Meanwhile, US and EU automakers are bleeding from tariffs, bureaucratic inertia, and leadership missteps. Tesla's distractions, Volkswagen's delayed action, Ford and General Motors playing defense. China isn't winning because others are losing. It's winning because it's out-innovating and out-hustling everyone else. Is 2025 just the beginning of the world's top car makers losing their dominance? In just a few years, China's auto giants have flipped the global industry upside down. Cars are built in half the time, sold at half the price, shipped across continents before rivals can even redesign a bumper. While General Motors, Volkswagen, and Tesla are still planning, BYD's $7,800 electric vehicle is already landing in showrooms across the globe. How did the balance of power shift so fast? In today's video, we will break down the quiet storm shaking the auto world and how Chinese automakers left others in the dust. Hit the like and subscribe button for updates, and let's get into it. China is not just building electric vehicles, it is shipping them to the world at a pace no one saw coming. In the first 5 months of 2025, Chinese EV exports jumped 19% year-on-year. Leading the charge, Chery with over 250,800 units exported, Morris Garages with 168,700, and Geely at 160,900, up an insane 103% from the year before. Even BYD, despite its focus on domestic dominance, exported 159,300 vehicles, a number that is only expected to rise. These exports are not flooding low-cost, low-demand markets. Chinese automakers are breaking into Europe, Southeast Asia, and Latin America, which are regions of high potential and high stakes. In Brazil, EV sales soared 187% in 1 year, and Chinese brands now make up 90% of the active EV fleet. In Singapore, BYD has left behind longtime leaders like Toyota to become the top-selling car brand. What's behind this surge? Affordable pricing, fast development cycles, and smarter global logistics. With vehicles that cost less but offer more, Chinese brands are proving they don't need a legacy reputation to win, just a better deal for the buyer. Next up, we'll see how US automakers are struggling to keep pace in this high-speed race. America's automotive heavyweights, General Motors, Ford, and Tesla, are getting lapped by China's fast-moving EV machine. General Motors is staring down a $4 to $5 billion hit in 2025 from Trump's sweeping 25% import tariffs, slashing its earnings guidance and forcing production shifts back to US soil. Ford is not faring much better. It suspended its financial forecast entirely, citing a $2.5 billion tariff impact and weak first-quarter results, including a 63% plunge in EBIT. Consumers rushed showrooms early in the year to beat price hikes, but that wave has crashed. Now prices are up. Ford's pickups and SUVs jumped as much as $2,000, squeezing middle-class buyers.